But I hope it'll be helpful information for you. This is the second in a series about starting your own business. And in the very first lecture, I reviewed all of the sort of different structures that are available and the 6 primary things you could consider in determining which is the right fit for you. Those included what the startup costs were, how easy is it to manage, liability and tax issues, changeability, and what happens if it doesn't work out. And so this particular lecture is going to go a little bit more in depth about the 2 simplest and most straightforward of the business entities, which are sole proprietorships and general partnerships. And because they're easy, people often take it for granted that there are things that that you don't have to have any sort of rules or regulations or any sort of understanding, and often get themselves into trouble because of that. And so I subtitled this lecture, Getting It Right So It Doesn't Go Wrong. And that's primarily it. It's how to avoid problems with the IRS in particular, and friends and family and as well. So let's talk first about sole proprietorships. It's certainly the simplest, most straightforward way of conducting business. There's no bureaucracy, there's no titles or anything like that. It's created just informally on your own, saying I want to do it, and the business has no separate identity from you. There's no recognition from the state because nothing is filed with the Secretary of State's office. And when you file your income tax returns, the business doesn't have its own tax identification number. It uses your own Social Security number. And you usually are attaching those sort of business expenses on a Schedule C on your personal income tax return. Because there's no, formality in that way, there really aren't any upfront costs, right? Other than, just your logo marketing if you have a website or something like that. But just because it's easy, again, it doesn't mean that there aren't certain things that you should do. And the biggest concern in sole proprietorships is avoiding any confusion. And that's 2-pronged, right? Confusion for your customers and then confusion for you as the owner. Customers of your business have the right to know who they're dealing with. So if, they've contacted Do Right Enterprises, they need to know who Do Right Enterprises are. And if it were any other structure, they're able to call the Secretary of State and say, all right, can you look up this entity, who's the contact person, and use that information in order to file a complaint if they have one, or any other important legal business with the business. But when it's a sole proprietorship and nothing is filed with the Secretary of State, the way that is done is through each individual county where the business does any sort of work. And it's by filing an assumed name certificate. It's often called a DBA, or doing business as. So that if you're Do Right Business here in Hays County, you would file over in San Marcos at the county clerk's office, where the real property records and stuff are kept. It's in that same office. You would go in, fill out an assumed name certificate, and you would file it. And they're usually good for 10 years, but you have to file one in each county where you do work within the state. That is required by law, unless you're actually using your name for the sole proprietorship. Assuming that I was, doing my work as an attorney in my own name, Carrie Campbell, attorney at law. I don't need to go file a DBA for that because people are very clear on who they're dealing with. But if I were to do Munger and Campbell Law Firm, people are going to need to know they're dealing with Carrie Campbell. The other risk is with confusion with the people who are running it themselves. It takes some sophistication, right, to operate a business. And especially if you're going to have employees, it becomes a lot more complicated if you're paying payroll taxes and unemployment and all the various things that come along with that. But even in the simplest of terms, it's just you working out of your house. It's important to have boundaries, very important boundaries on your bank accounts and your credit accounts, loan accounts, those sort of things. Because again, you're going to want to respect that for IRS purposes and avoid getting audited. I worked with a family in Houston who were immigrants, not very familiar necessarily with the laws and how business is conducted here. And they started receiving credit cards for their business, and they were using it for anything and everything that came along, filling their gas tank and for, and then anything that was in the business credit card, they listed it then as a tax deductible expense. And it sent off a lot of red flags, and they spent months and months being audited by the IRS, and very expensive mistake. So regardless of the fact that there isn't any state mandatory, bureaucracy, those boundaries have to be very clear about what you're doing. Is that in the course and scope of business, or is it not? And if it's not, then you need to be making sure that you have it clear in your head. Working with an accountant would probably help that keep it clear. But for sure, if you're in a sole proprietorship, make sure you file your DBAs and make sure you keep your accounts separate. With partnerships, the difference is, instead of it just being a single individual, you have 2 or more partners now who are sharing the profit and the loss and the management of whatever business it is that you're operating. And there are specialty partnerships. There are limited partnerships. These are ones that are created sort of as a way of sharing profits, but losses. Like if you are a limited partner who is investing in a limited partnership, what your loss is limited to what your investment is. But you also have certain liability protections because you don't involve yourself in management. If you go in and you start telling people what to do, then you're treated as a general partner and not a limited partner, and you've got full exposure as the general partner usually does. In order to get any sort of liability protection from the state for a partnership, it has to be one of these specialty partnerships. And they do go through the bureaucracy of being registered with the state. Limited partnerships are $750 to initially file, and then you've got to pay $50 every 4 years to maintain it. And so that's not the primary focus of this particular lecture. But I will briefly also mention there are limited liability partnerships. Those are now for professionals. Those are for people who are accountants, attorneys, doctors, and they're wanting to limit their liability in some way by saying, look, I'm only liable for the work that I'm actually touching, those files and clients that are mine and not my client, my partners. They deal with their own. I'm only liable for my own, and they are liable for their own. Again, that has to go through the Secretary of State. It's $200 per partner per year, and you have to prove that you maintain a large liability insurance policy in order to have that. Usually that's cost prohibitive for a lot of these startup businesses. And even if it's not, I will tell you that, when you start looking at, $750, $200 a year per partner, you can buy some nice liability insurance coverage for about that same price. And so I actually made that decision once upon a time that initially my law firm, we had 5 attorneys at one point here in Hays County, but as it kind of got down to where it's just me and one other at this point, we decided to drop the LLP because for the price of $400 a year, it was easy as, we could get more liability coverage that way and protect ourselves in a way that was much more specific, even for our own work product and not just for our partners' work products. But focusing in on general partnerships now, on what most people are doing, and they'll go into business with a friend usually, or family. And there's, only difference between this and a sole proprietorship really is that you're dealing with 2 or more people. And you have to, because you can't use your own social security number like in a sole proprietorship, because there's 2 of you. The partnership does have to get its own tax identification number, even if it's not registered with the Secretary of State. And it will get a Schedule K. It doesn't pay taxes, but an accountant would prepare a return for the partnership. And then you would get a Schedule K, as would your partner, that allocates the income or loss for that year based upon the percentage of your ownership. Just because you're partners doesn't necessarily mean it's 50-50. It's whatever the 2 of you or more agree to. So you do have sort of that forced boundaries that you don't have with a sole proprietorship. By having your own tax identification number, you're going to have a bank account that is separate from yourself. It's otherwise informal. There's nothing that's on with the Secretary of State. And just like with a sole proprietorship, if you're calling it by something other than your individual name, you're going to have to file those assumed name certificates in all the counties where you do business. The way to protect yourself, your business, your relationship with your friends, your relationships with your family, is to have a partnership agreement. And that should be in writing. It has happened so many times, I can't even, I lost count probably a couple of decades ago on how many of these businesses, people don't do their homework. Oftentimes they decide, oh, I've got a really good recipe, right, for picadillo, so I'm going to open up a restaurant. And, we'll split. I'll do mornings, they do night, and you come in and there's not a full and complete understanding of what that's going to entail, especially restaurants that often come and go very quickly. And so anytime you have a partnership agreement, no matter how many partners there are, to put it in writing and for everyone to sit down and to consider the issues of the partnership. How is this really going to work? Good times and bad times. Then it avoids the disputes and the misunderstandings. And you've got a resource and a reference that you can go back to if things go wrong. But hopefully if they don't, you still have that resource and reference to keep things going right. Many banks, even if you have a tax identification number and you go in and say, I want to open a bank account for Do Right partners, they are going to want not just a copy of the assigned tax identification number. A lot of them want to also see the partnership agreement and want to know who has the authority to sign on the accounts and stuff. So even if you're about doing it, if you want to open up in a bank, especially in some of the local banks here in Wimberley, you're going to need to have one in writing for that as well. And when you're contemplating what should be in this partnership agreement, there's some very basic things that should be at least discussed and then put in there. Most especially the name, right? You've got to agree as to what the name of the business is. Make sure you file those DBAs. What is going to be the relationship, between the people? Who's going to be putting in cash? Who may be putting in property or equipment? Who's going to be perhaps providing services? What are those services worth as compared to those who are putting in cash? That is so detail oriented that those are easily misconstrued or misunderstood between partners. I thought they said I got 50% of the profits from the beginning, and the other one, yeah, you get 50% of the profits, but only after you do X, Y, and Z because I put in all this cash first. That's the one I've heard most recently last week. So, those things can be thought out and understood. If you're putting in services, what are your services worth? Are they roughly worth, the expectation of so many hours a week and a dollar sort of value assigned to them? So what are going to be the risks? How are those shared? How are the benefits of that business shared? Not just profits, but if you run the risk, you're running this restaurant that I referenced a while ago. What happens if I'm a partner and my kids are going to be dropped off here every day from school and I'm going to be feeding them? And then their friends, those sort of scenarios happen, and they happen quite frequently. So it's not just the benefits that you as an individual get, but, am I allowed, what's the parameters of this situation, as far as what am I allowed to do in this role without having to check with my partner every day, and this is what I would expect to do. And then responsibilities of that ownership. How many hours are you going to contribute? If you say, okay, I'm going to do the morning shift and you're going to do the evening shift, what happens when one of you are sick? What happens if one of you, needs to go to a school event, or if there's understaffing that it happens? And so many different risks and benefits and responsibilities with that you may have talked about it, but go ahead and put it in writing, because those kind of conversations, people hear what they want to hear. And if they've put it in writing, read it and signed it, they're more likely to remember it correctly. And if they don't, you've got the proof to back that up. The other thing that should always be in a partnership agreement is capital investment. As far as going into the future, I mean, we just talked about what happens to start with. How does it get started? But what happens if you're 2 years into it and you want to make some improvements and update the kitchen? Well, what are the responsibilities and expectations of each of the partners as far as contributing towards those sort of capital investments going forward? What happens if there's a loss and one of you has the ability to cover it and it doesn't? Do you treat those as loans that you have to pay back as a priority before you do any additional profits? Wonder if you can't do that because, the one that's not cash rich at the moment is going to have to deal with needing that salary or wages in order to take care of their living expenses. How do loans get repaid then if it can't be done on a priority, if it needs to be done on a monthly basis? Are loans permitted? The conditions? Who is going to make the various management decisions? Who's going to make the staffing decisions? I mean, it obviously won't work if one hires and the other one fires the same day. You've got to have, again, management, unlike sole proprietorship, which is, everything. When you're in a partnership, you need to have some agreement as to what you each are going to be taking care of, so that you're not either contradicting one another or are making it impossible to maintain. It's a lot of work. Usually somebody is better with finances. One person's better with people. One is got to be allocated, to deal with the tax returns and to be able to sign a tax return. And even, like I said, staffing issues or inventory, or just all of those various things that if you even make a simple chart that you attach as an exhibit to your written partnership agreement, you've gone a long way in preventing any sort of problems or misunderstandings. Doesn't mean they won't come up, but you've got a way of sort of dealing with it. And probably as important, if not more important, to those who are going through it, what happens if your partner, retires, if they die, if they become incapacitated? What happens if they divorce? And in a lot of those circumstances, what you don't want is to end up having to be in business with someone you don't like or know. So that, if they either get divorced or they pass away and their heirs inherit their share of the business, are you suddenly responsible now for carrying on a business that's very personal to you with somebody who doesn't even live where you are? And so there are ways to deal with that. And you can, ask about those with an attorney or doing some research and stuff. One way, for instance, is to have a life insurance policy that the partnership actually owns. It pays the premiums, it owns it, so that the benefit of those insurance proceeds actually come to the business. And then those resources by the business are used to buy out the partner's heirs that has passed away. Either that, or you have other certain conditions. You set an amount, or you base it on fair market value, or you require that the heirs have to sell it to you, and make it a condition of going into business together. All that needs to be in a written partnership agreement. And other things that might be particular to your work product should also be included in that. Regardless of whether or not you're a sole proprietor or whether or not you're a general partner, you don't have the choices that other entities have that have gone through the process of registering and being recognized by the state. As far as, tax benefits and stuff, that those are not available to you. You are going to be paying self-employment taxes, and you are, going to need to either file it as a Schedule C or a K on your personal income tax returns. You can mitigate, though, the risk on liability by having a liability protection for your business. You can contract with any sort of insurance provider for a general liability policy. That general liability policy makes sure not just you as owners, but if you have a manager or someone that is doing it, that they're also covered as well. And, that's really an essential business expense. And that will go a long way. It doesn't go all the way, but it will go a long way in protecting personal assets from any losses as well. The choices of, does the business own property or it doesn't own property, those kind of things regularly need to be discussed with an accountant. Most of the time, if you are not one of those structures that have been registered with the Secretary of State, there's not as significant a difference, because you own it or the business owns it, you are the business. It's just an alter ego. But if you ever decide to convert to one of the state recognized entities like limited liability companies or S corporation, C corporation, one of the other types of more specialty partnerships, the questions of what should be and should not be in the business name versus your personal name become, more particular. The other thing, by having an entity like a partnership or a sole proprietorship, having separate accounts and stuff, is there are still ways, and that's why I said check with your accountant, that you can minimize other taxes. Like I said, you're going to be paying self-employment tax, but for instance, if you're working out of your home, you might still go ahead and have a rental agreement between you and your partnership or the name of your business, because then whatever part or percentage of your home is being used for that office is something that your accountant could assist you with writing off home business expenses, shared expenses, utilities, that sort of thing, internet, as well as some depreciation costs. So ask those questions of an accountant. The other thing I would say with regards to insurance, again, another ways to protect yourself if you're in a sole proprietorship, any time of partnership, or frankly, the others, any of these business entities, there is a rider that can be put on to a general liability policy called a hired auto, like short for automobile, hired auto. And what that does is it covers anyone who's working on behalf of the business in the course and scope. And a lot of people take for granted the idea that, okay, I'm going to run down to the bank to make some deposits. I'm running to the UPS store to ship off some product. And, you think, well, I'm in a sole proprietorship or I'm in a partnership. My regular auto liability policy is going to cover me. It's fine. I'm using my own car. Some insurance companies will deny coverage if you are in the course and scope of business. So clarify that. And if by chance they do, and get it in writing, have it in an email, ask your question in email so you have that response in from your agent, and keep those with your business records in the event that happens, because a lot of times that doesn't, it's a means for them to make a denial that you can cover then with this hired auto provision, this rider that you can add on to your general liability policy. It's, I'm trying to remember, it's around $60 a year to add it on. And then it covers all of those instances where you or anyone who's working for your business are on the roadways. Because frankly, you may not have that much liability exposure if you're, at home and you're doing something that doesn't put the public at risk in any way. Then, where they're at the greatest exposure is when you're on the road, and making a mistake in a car is one of those little areas that can get away from you, and you don't think about it or plan for it. And this is something that you should at least consider, and consider the hired auto rider. So that's about all I have for right now with regards to the sole proprietorships and partnerships. We have another lecture in 2 weeks that is going to be covering LLCs and closely held corporations, so subchapter S corporations, and we'll get into kind of the nitty-gritty about those two organizations. But before we sign off today, does anyone have any questions? You'll have to unmute yourself if you have a question, and I'd be happy to answer. Hello.
Hello, this is Tim.
Hi, Tim.
Hey, on these sessions, are they being posted or recorded or on the Wimberley Library somewhere?
I believe they are being recorded, because I see a little light up in the corner. Nami Gonzalez told me she was recording, but I do not know yet where those are posted. You can answer that, Nami?
Yes, once the video is ready, I'll post it on our YouTube channel, but I can email you a link to it if you would like.
Yes, please. The other question I have, looks like it might be more pertinent to the session in 2 weeks, is transactions between these entities, how best to document those or track those. So like today you talked about yourself and the DBA. I mean, should this all be documented if I take money from myself and put it into the business, or vice versa? How strict is the IRS or the state going to get on that sort of stuff?
Well, it's very challenging at times to predict how the IRS is going to be, because we've certainly gone through cycles of the barking dog IRS and then the kinder, gentler IRS. And so, at this time, I don't know of very many audits that are going on. They're so swamped and understaffed with even processing the standard tax return forms that are being filed, especially since they were tasked with also distributing these COVID recovery stimulus checks. And so I personally don't know that many audits that are ongoing right now, but in earlier times, I would say there is no harm in documenting anything, but there are plenty of times that you might regret not documenting anything. I would always err on the side of caution. Now, in sole proprietorships and in general partnerships, you don't have such thing as minutes. You don't have meetings that are typically documented in any way. We will talk about that for LLCs and S Corps and stuff, about how those would definitely, when we discuss it in 2 weeks, be documented as little resolutions and very easily done. But in the absence of that, you want to keep a paper trail where you can go back. So if you are starting, for instance, this partnership or the sole proprietorship, and you are putting in the initial money and you want to later pay yourself back for it, you write on the check that this is startup cost or this is a loan, or you write what it is and make copies of that. Absolutely, you keep a paper trail. And frankly, if you do that and you are conscientious about it, the likelihood is you're not one of those that are going to get audited, because you'll be doing it right from the beginning. Any other questions?
No, thank you. Thanks for the session.
Sure. Okay. If there's no other questions, then I'm not sure the date, but 2 weeks from today, same time, 1 o'clock, Tuesday. See you then.